In that book, Corley stated that almost half of the millionaires he studied took the saver investor path. In this video, I'll tell you the 7 things that millionaires don't invest in so that you can also make good investments and get rich. One of the best ways to succeed is to follow the footsteps of people who have already done well, and this method works well for investing. If you're new to the channel, hit the subscribe button and that little notification bell icon so that you don't miss out on any of our video updates. Plus, it helps us spread the Thrive Wise love to help more people thrive wisely. Now, let's begin. So, what kinds of investments do billionaires stay away from? Well, the first one is penny stocks. A penny stock is a share that trades on the stock exchange for less than $5 per share. Millionaires stay away from them as if it were a contagious disease. There are a few important reasons why millionaires don't invest in this way, and the first one being that companies with low-value shares don't have to sign up with the Security and Exchange Commission, or the SEC, and they don't have to give them their annual reports. Basically, this means that no one is checking to see if the financial information these companies report is true, which makes them a very risky investment. Also, if investors don't have access to reliable financial information, it's hard for them to know what their investments are really worth, which is a big part of how millionaires choose to invest. Now, it's true that these types of stocks could give investors who are willing to take a chance on unproven companies the chance to make a lot of money, but millionaires on the other hand know that penny stocks will always go down. Another reason why penny stocks are bad investments is that they aren't very liquid. Since most people don't buy these kinds of shares, it can be hard to sell the ones you own. Most popular stocks are bought and sold thousands of times a day, but penny stocks are bought and sold less often. This affects the price of penny stocks, which is another problem with them. When you have investments with prices that go up and down a lot, it can be hard to figure out how much they are really worth. It can also be very stressful to watch your money go up and down to extreme levels over time, and because of these factors, millionaires don't buy penny stocks. Number 2, bonds. Well, it's true that a lot of millionaires have bonds in their portfolios, but this type of investment is usually avoided by millionaires who want to make the most out of their money. The first problem with bonds is that their returns are usually much lower than what you could get from investing in stocks instead. In fact, many bonds barely keep up with inflation, earning an average of only 3% per year. For example, the average inflation rate in the US over the past 3 years has been over 2% per year. This means if you've invested $30,000, you would be ahead 1% or $300 as a net return. So, if the returns on bonds are so low, why would anyone buy them in the first place? The truth is that bonds are usually safer than stocks and are fairly liquid, so you can get your money back quickly if you want to sell them. Also, bonds usually pay interest, which means they are assets that bring in money. Unfortunately, their low yields make them more of a way to keep money than to make it. This is why millionaires don't usually put a lot of money into this type of investment. Number 3, certificates of deposit. Certificates of deposit are another type of investment that the rich don't engage in. If this is your first time hearing it, let me explain what certificates of deposit or CDs are. A certificate of deposit is a product that banks and credit unions offer. The customer agrees to leave a huge sum of deposit alone for a certain amount of time in exchange for a higher interest rate. Basically, you're giving up the ability to use your money in exchange for interest income. CDs have the same main problem as bonds, which is that they aren't as safe. They don't give you very big returns, so you won't be able to keep up with inflation by investing in them. As of October 2022, the highest CDs only pay 3.60% per year. On the bright side, one good thing about certificates of deposit is that their terms are usually shorter than those of bonds, which means you can get a similar return while not being able to use the money for a shorter time, which means less risk. Even though CDs aren't a bad investment, millionaires expect higher returns and engage in other investments that are guaranteed to build their wealth faster. Number 4. Digital currencies. In the last few years, Bitcoin and other popular cryptocurrencies have been all anyone has ever talked about. Millionaires tend to stay away from this kind of investment. Though now I'd be lying if I said nobody ever made a lot of money by investing in crypto. But these people are rare. One problem with digital currencies is that they are not regulated by the government. This means that there's no oversight of how the companies behind them run, which can be scary if you are investing a lot of money in them. The second problem with cryptocurrencies is that they don't have any value in and of themselves. Their prices are completely based on speculation like penny stocks. This makes their prices go up when there is a lot of buzz about them and go down when people stop talking about them. For example, in December 2017, when Bitcoin got a ridiculous amount of attention, the price of a single Bitcoin went up to over 17,000 USD. Then, as the stress around Bitcoin went away, the price started to go down, and the investors saw their once favorite cryptocurrency bring in just over 3,000 USD a year after its peak. Lastly, it's not safe. Hackers and thieves can take digital currencies, which is not the case for other investments. Take for example Mt. Gox. Mt. Gox was a cryptocurrency exchange that opened in 2010 in Tokyo, Japan. At one point, it was the biggest cryptocurrency exchange in the world, handling more than 70% of all Bitcoin transactions worldwide. In 2011, hackers broke into the exchange and stole Bitcoin worth over $8.75 million. Sadly, this happens all the time. According to a study by the US Department of Homeland Security, about a third of all Bitcoin exchanges have been broken into at some point. When you add up all of these factors and the fact that cryptocurrencies don't produce income like investment properties or dividend shares do, it's easy to see why millionaires rarely use digital currencies as their main investment vehicle. By now, you may have an idea of how these investments differ from each other and why you should avoid them. What struck you the most? We'd love to hear what you think about this as we all try to help each other out. And heading back. Number 5. Precious metals. The fifth thing that many rich people don't invest in is precious metals, and gold in particular. Now I understand why some people want to put their money into precious metals. In general, gold and other precious metals can be a way to protect yourself from bad economic times. This is because precious metals and the stock market tend to move the opposite direction. Just to say, gold and other precious metals tend to go up in value when the price of stocks and bonds go down, and they tend to go down in value when the prices of stocks go up. Now you might be thinking, isn't it smart to have investments that will make up for any losses? In theory, this all makes sense, but in reality, the prices of precious metals don't usually go up enough for you to make up for the losses you'd suffer in a bad economy. This makes them a poor choice as an investment option, especially when it is the only one you have. The other problem with holding precious metals is that, like most of the other investments we've talked about in this video, they're not very liquid. Again, if you are short on cash and need to sell these assets, it may be harder than you think, leaving you without the money you need. And if that's not enough to convince you to stay away from this type of investment, you should know that Warren Buffett resonates with this idea. Buffett thinks that stocks are a much better investment than gold or silver, and he often talks about how much better the return on stocks have been in the past. For example, if you put $10,000 into gold and stocks in 1942, your gold is now worth $400,000. Now that might seem like a great return, but the same $10,000 invested in stocks would be worth a cool $51 million today. Number 6. Collectibles. Collectibles include things like art, antiques, stamps, classic cars, wine, and comic books. And believe it or not, they are a big thing. A report from Deloitte said that the market for collectibles was worth $62 billion in 2012, and it was expected to grow every year. Even though collectibles are expected to grow in value, millionaires still don't put their money into them for a few reasons. First, collectibles are only worth what someone else is willing to pay them for. This means that there is no real price for these assets. Similar to cryptocurrencies, the value of these assets is based on how much other people think they are worth instead of having a real dollar value. This means that even though you think your exquisite painting is worth a lot, it isn't worth anything unless someone is willing to pay the money for it. Also, unlike stocks and bonds, there isn't a lot of public information about individual collectibles, and you only have a specific target market for them. This makes the process of valuing them even harder. The second reason why rich people don't invest in collectibles is that they don't bring in money. A painting is nice to look at, but it won't put money in your pocket every month, and it's not the best thing to invest in. The fact that collectibles are hard to sell is probably their biggest flaw as an investment. For example, it takes the right kind of buyer to want to spend thousands of dollars on an antique car or a collection of comic books. This means that if you want to sell your collectibles to get some money back, you may have to wait a while. Putting it all together, collecting valuable things can be fun, but they aren't the best investment. Number 7. Companies you don't understand. At this point, you've probably decided that stocks are the type of investment that most millionaires choose. However, not all stocks are good investments. This is because many companies that trade on the stock market are so complicated that most investors can't even figure out what business they're in. Even experienced investors like Warren Buffett won't buy most stocks because of how complicated they can be. And he's been investing longer than most people have been alive. Buffett says that you should only invest in companies you understand, and he does the same thing himself, by only investing in companies that are in his circle of competence. His area of expertise as an investor is called his circle of competence, and only businesses that fit into this circle are considered for investment. Buffett says that you can't predict how well a business will do if you don't understand how it works. When the tech bubble burst in the early 2000s, Buffett didn't lose a lot of money because he wasn't heavily invested in dot-com stocks. In short, investing in stocks is a great way to make money, but you should only invest in companies that you understand. If you want to start investing like a millionaire, you should avoid bonds, penny stocks, digital currencies, certificates of deposit, collectibles, gold, silver, and companies you don't understand. People like Warren Buffett and Charlie Munger's ways of investing are studied for hours and hours by thousands of people. But these business moguls only learn how to invest from those who came before them. It's just as important to know what investments to avoid as it is to know what investments to make. When you're trying to build your wealth, some common investments can look like winners, but some of them can actually cost you money in the long run, which is why it is important to learn about them first and weigh their cons and pros. And there you have it, the 7 things rich people don't invest in. If you enjoyed this video, then you will probably learn a lot more from watching this video, or secrets to getting rich from nothing. If you click on the screen right now, you can go and watch that. Do you want to learn more on how to thrive wisely? What videos would you want to watch next? Feel free to comment down below. And please don't forget to click the subscribe button to see more videos on how to thrive wisely. Till next time.